Good morning, everyone. This is ProTrader Mentoring for Saturday, April the 12th, 2025. And we're going to continue with the last topic in the channels, about the channels that we talked about last time, and then move on to the next section. So, all right. Okay. Let's get rid of this. All right. So last time I talked about channels, and we got to explain almost everything about channels up to the last topic, which is late signal bars and late strength. So where is the whiteboard? Here it is. Okay, so channels. Late strength. And late strength means, let me see if I can find a chart from last week here. Actually, the daily chart is an example of that. So here's a channel, and it has had many legs down and, a significant break of the bear trend line here. And then we have another breakout going down. So that is late strength. Now, sometimes it leads to a complete reset and the channel starts a basically new trend. But most of the time, this is what you get. So market starts to pull back and it starts to go sideways and turns into a trading range. That's the most likely outcome, which is what I said last week when we were talking about the weekly chart and hard time frames daily chart. I said that this bar is too strong, too big, so the market is probably going to fall below it, test the low of the bar. But then when it does, it's at major support, and it is more likely that it will turn up and go sideways, which is what happened. Usually in channels, when price suddenly becomes strong late in a channel, it is usually the end of the move. Okay, so conditions are channel must be going on for some time. The channel must have several legs in it already. Okay, so what do you think several is? How many legs?
At least three?
At least.
Yeah. So 3 is a good number. 3 to 4 legs in the direction of momentum, which is the slope of the channel basically. And then you get at that point you have a strong breakout, and that strong breakout is late strength. Okay, so late strength outcome usually, so this turns into trading range or reversal. So trading range usually, and that's the more common thing that you will see. Reversal, less common. Now, if it is going to turn into a trading range, naturally you're going to get a reversal. Okay, so that goes without saying. But when I say reversal, it means, for example, the bull channel ends with a very big bull buy climax, and then you get a reversal that goes back down and tests the beginning of the channel. that is less common. Usually you get a trading range because that late strength is new energy, and that new energy must be used up in doing something. It's rare that you get a very big move and it stops and completely reverses. Now, having said that, there are situations where we get the reversal scenario, but that reversal scenario is usually tied back to the direction of the higher time frame. Okay, so for instance, consider this. We have, in this case, we're talking about this one. So higher time frame, strong bull market, and so two conditions early in the cycle. Okay, lower time frame now has a bear channel plus late strength. Okay, this is actually one of the cases that leads to that low probability, less common outcome, which is a reversal that completely goes the other direction. But it is usually influenced by the momentum of the higher time frame. A great example of it, if I can find that chart, that'd be really, really nice. As it is typical, usually when something hurts you really badly and you immediately remember that forever. And that the case was, many, many years ago, he was trading short and he had one of these late strength reversals. And at the time, I didn't know that I had to check the higher time frame because that is what is going to ultimately, dictate how the day is going to look like. And I couldn't believe my eyes on the speed and ferocity of the change of direction. Maybe it's not this day, but this can serve our purpose too. Right, okay, so let's take a look at this one, but I have to spend some time to find the chart I want, but this also shows you what I mean, okay? So this is an old chart. It is from 2014, June the 5th. So higher time frame, daily chart was in a very strong bull trend at the time. And what do we have here? We have a bear channel, basically, that's getting strong quite late in the cycle, in the life of the channel. And it has already several, like 3 legs down, or maybe 4. Yeah, definitely 3 legs down. And then you have the best looking bars coming late here. And then look at the reversal. Starts with a doji looking bar, but doesn't stop. And this is a function of the higher time frame. So higher time frame, you don't see the daily, but it's very easy to find the daily chart for June of 2014. It was in a small pullback bull trend. And every time we had the channel, it would result in a sharp reversal. So it was one of the things I remember from that year. Now look at, this is 15-minute chart. This might be interesting too, to take a look at this, because this is that year. And you see what happens. Every time there's a test of the moving average, there's a bounce, and the market goes immediately higher. And look at the price, less than 2,000 back in the day. Then you could have traded E-mini with about $5,000 in margin then, but now it is 3 times bigger. All right, so this is the low probability outcome. Usually what we get is a trading range. And when it is a trading range, you get your late strength. I mean, we are not seeing it here, but it starts to go sideways. That's the most common outcome. So if you're trading the channel for a reversal, the expectation, the realistic expectation is really a scalp or a smaller trade, like not a swing trade. Because the swing version is the low probability version. Okay, so that's one thing. Then the other thing is the way it starts, the transition between that very strong move and the trading range is usually with something that doesn't look even interesting. So like a, doji, like the chart I showed you, a doji bar, a weak signal bar. But it works. So it takes a little bit of practice to start trusting it. But if you see the channel and it is in the opposite direction to the direction of the higher time frame, especially, and it is at a major support, then the ingredients are in place for maybe this one, but at least a trading range. That's the highest outcome. Now, once we say that, we also have to talk about the failure case. The failure case is when the breakout leads to a new trend. What do you think we should look out for that?
So the failure, a breakout that leads to a new trend. So the tight channel that was getting climactic leads to a new trend. Is that
Yeah, so suppose this is our
the
channel.
question?
Yeah. And then you get late strength. You get a series of very strong bull bars late in this channel. So we learned that, yeah, there are three outcomes, right? Three outcomes here. So number one is trading range. Two is reversal. And three, obviously, is follow through. And that follow through is a reset, basically. Reset. It becomes a new spike and starts a new market cycle. So if we want to assign probabilities here, this happens less than 25% of the time. These two, both of them, they happen 75% of the time with the distribution of out of that 75%, the reversal happens 25% and the trading range happens 75%. So, I mean, you take this 75% and now this is the new 100%. Between these two, 3 out of 4, market forms a trading range. 1 out of 4, it forms a reversal. Okay.
Remember,
yeah, go ahead.
I was just going to say, I remember we got a lot of those last spring and summer, and I was ready to give up on, the whole concept of a channel being a flag. But really what it was just the market saying how strong, how incredibly strong that period was, bullish. And it was just it was a change of behavior, of what we would normally expect. And it was actually telling you a lot, giving you a lot of information.
Yeah, absolutely. Yeah, when the higher time frame is strong and it's in a tight channel, tests of the trend line of that higher time frame usually results in sharp reversals. And if it forms in this manner, which is a channel with late strength, then it leads to the scenario number 2, strong reversal, trend resumption on a higher time frame.
Hey, Mr. Ashari,
Yep.
what if it's a late channel and it's in the direction of the higher time frame as well? Like you said, it's getting late strength as well, but it's in the direction.
Yeah.
So, yeah.
Still, this is lower probability. That trading range is higher probability. So
that would basically be like a parabolic wedge situation.
All channels are versions of wedges. Like, actually, that's not correct. Wedges are versions of channels because we can't have channels that are not wedges. But having said that, as you know, wedges or channels in the direction of the market regime have lower probability of sharp reversals. Some of them do not even reverse. They form a small trading range and then there's trend resumption in the direction of the momentum. So that includes this as well. So same thing, same answer for your question. All right, so I'm going to talk about this one first. What do we need to believe this, basically? That's the question.
Uniformity and the 10+2, basically.
That is definitely one of them, but there are some contextual information here that are even more important.
Well, like I was saying, in the last spring and summer, the higher time frame was so strong that basically any reason to continue, so if there was a channel against the trend, you expect it to reverse really hard in the direction of the trend. But if it was in the direction of the trend, like we were just talking about, the best you could hope for was a trading range. But even as likely, maybe even more likely, was follow through, which, if out of context would be a low probability event. But so, yeah, I guess it's a very long-winded way of saying regime.
Yeah, that's correct.
Yeah.
So higher time frame context is obviously important. In this, everything comes back to context. Like most of it comes back to the context of the market. But day structure is also important, which means by the time you're getting it, you still have room to go. So it is not like, yeah, we're getting one of these things and already the entire range of the day is 180% of average daily range. And then you believe on a reset and that propels it up to another 100% on top of it. Days like that happen, but they usually are very rare, maybe once a year, twice a year, something like that. But on a typical day, on any typical day, to bet that the day structure is going to change dramatically as a result of this is actually a low probability bet. So you must have room in that framework of the day structure for this to still move on. And then, as you mentioned, relative strength factors. So those should be there. And amongst them, one of the most important one is you need an open breakout gap. Because usually the market tries to reverse and you want the reversal to not be able to close the breakout gap. So that means you probably have to wait to see, if the reversal looks strong, if it makes sense, it gets, strong bear bars, for example, against the new bull reset, all of those things. But these two are more important. Higher time frame context and day structure, especially day structure, because you need to have room within the framework of a day for the market to reset and go. And then as long as the gaps are open, you can always bet that, the test of those gaps and trying to close them are going to result in trading ranges and trend resumption rather than, a complete and utter reversal. All right, so any questions about these? Good, because I'm going to give you a homework. So homework here. The idea here is to understand the probabilities really. So what is the probability, the numbers I quoted up there, of late strength resulting in a successful fade trade. So you study a lot of these late strengths, and conditions that you're looking for, as I mentioned up there. So same conditions as above, with the caveat of channel line breaks. So the breakout really goes above the channel line and exceeds the boundaries of the channel. So that's one of the important things. The breakout is strong based on those 10 plus 2 strength factors, or relative strength that we talked about, I think it was 2 sessions ago. And it is categorically different. It is strong and the leg is different. So when you look at it, it looks like a spike, not a leg in a trading range. So leg in a trend. And then you want to fade it, okay? So how do you fade it? Any ideas of how do you fade it?
Wait for
the breakout in the trend direction that you're fading it to, so reverse it.
Yeah, look at this, all right? So this happens and you want to go short. How do you go short?
Well, there's a few ways. One, you could sell at a distance. For example, you could get a measured move either of the bar, like half the measured move, or like an average bar range. That would be probably the most simplistic way, maybe, or like one of the simplistic ways. And then you could sell the close, but that's not. You would probably sit in a drawdown if you do that. And if you look to the left, you could always probably maybe find like some resistance level there as well.
Yeah, so look at major resistance. Yeah, that's one of the ways. What else?
Acceleration and pause.
Yeah, correct. That's a good way. The easiest way is actually to wait for the bars to approach that market tempo cycle. Okay. And the other way is you look at, something that completes this leg. And that is, for example, that could be, a big, small, big. It could be, a big breakout bar followed by so the opposite. So small, big, small. Okay. You wait for this to show you at least a cycle of volatility that's been completed. And that is usually low volatility, high volatility, low volatility, or high volatility, low volatility, high volatility. One of them, depending on how this starts. And it's even better if this thing has a pause or something in between. So you know that at least on a faster chart, there is a two-legged pattern. And that could be just a small, pause bar, or a like this, for instance. So everything is good. Then there is a small bear bar, and there's another big bull bar there. And it's all in a micro channel. So there's no trend line break here, but there is a pause in between. So that is also good. So one of the things that some traders do is they wait for that pause bar. They hope that they get it in the first place, because sometimes you don't. And then after this is in place, they start to sell at about one average bar range above the top of the bar. And they look at the bars that are completing this to be about the same size as the bars that started it or formed it. So for example, if the bars are, if the bars in the channel used to be 10 points on average, and these bars are 20 points, and they see that, they sell at about 20 points higher. So they don't reference the channel, they reference what the event, the last thing on the chart is. Obviously, the other method is just to wait for a signal bar and wait for a follow-through bar. So traditional swing entry signals. That's another way. my preference, if I can find that chart again, that would be nice. Just mean, it was the 6th of, oh, okay.
June 5th. It was June 5th,
Yeah,
2014.
yeah, just found it. Here it is. My preference is this. Well, look at this late strength leg. You see the pause there? So big, big, pause, big. So the big went down and reversed up. But from a structural point of view, there is volatility expansion, volatility contraction, volatility expansion. Okay, so this completes that volatility cycle. As you said, Castro, it is at a support level, so measured move based on the bull flag that failed and resulted in that. So that's good. The other thing is it reverses up. So, there are buyers about one average bar range below that bar, below the pause bar. It would have been nice if this was a bull bar, really, rather than a bear bar. But sometimes the bear bar also works. I mean, the bar in the direction of the latest strength also works. And then the way I like to trade it, all of these things are not really all that high probability. I mean, I'm not saying it in terms of math, because if you do the homework, you will see that they are actually quite high probability. But it's about trading style and the emotions of the person, because you also have to take care of yourself too when you're trading. So my preference, if I don't fade it, just buy it down there, because sometimes I do that. Like the same trade I took in Orlando was this. But the other way that I really like to trade it, so I don't like to buy the signal bar, I don't like to buy the follow through bar. The V reversal is the low probability outcome. Usually you get one more test down, higher low, double bottom, something. But if you don't get that, and this is what we have on the chart in front of us, I like to look for a low probability or a bad looking trend resumption signal. And that would be this bar, inside bear bar with a tail below. That is the bar I like to buy, or buy below the bar, or bet that the test of the high of the last bar, or if there's a micro gap here, is going to provide enough support for the trade to work. So that would be one of the my preferred entries. And that's it.
Hey, Ollie.
Yeah.
I've always been meaning to ask you this about that concept of the low probability.
Oh, Ben, it's been a long time. Why didn't you ask me earlier?
Well, it's something that I could do it either way, so it doesn't really affect me personally, but I've always wanted to get your answer on this.
So I was kidding.
So,
yeah, sure.
Yeah, no, I know. So I don't think you have bar numbers on here, but like the third bar up, the like the climax bar after the reversal.
This predates me coding. Yeah. So
Yeah, no problem. Yeah, that third bar there, the largest one.
The bear bar, the doji. Yeah, the inside bar.
No, so this is my question. Before that, you could do two things. You could set a limit order right there at the high of the prior bar and basically look for the micro gap to get filled, right?
Yes.
As a functional price level.
Yeah.
But you often say, one way to get in is to fade a bad signal, counter trend signal bar. But why is that better than just having a limit order there? Is it because you get to see the strength of the bears and see that oh, okay. So that
so it gives you it's like signing a contract blind, or sitting across the table and looking at the person who is offering you the contract and then signing it.
That's what I thought. No, that makes a lot of sense. Thanks.
Sure. All right, so that is probably everything that I wanted to say about channels and late strength, but do this homework. It's going to probably astonish you at the probability of fading these late strengths. Now, if you do this, please also pay attention to this scenario. So this is like a bonus addition for that homework. So sometimes you get late strength plus strong reversal signal bar. So probabilities. You want to know what is this going to do to the probabilities. And the other name for this is climax reversal. So you have your late strength. So let's say in bear case, so we have the bear channel, and suddenly we have those very strong bear bars. Okay, and then here there's a decent looking reversal signal bar. That's what you're looking for. It doesn't usually happen because most of the time, you know, the way this ends and starts is a bit based on a bad signal bar, you know, doji bar is something that doesn't look right. But, you know, once in a while you get this version, and then I want you to study the probabilities and see how this one is different from the majority of the other cases. Okay. Do we have an example here? Just eyeballing it quickly. Not really. I mean, you can say this, but this is not really late strength. This is a failed breakout below double bottom. So yes, it's a channel. It is directional on the in the last leg, and then it reverses. But this is not what we're looking for. We're looking for, like the example I showed you, a channel that has momentum, and then it gets even more momentum, and then there's a decent looking signal bar, reversal signal bar. None of these.
Hey, Mr. Avshay, why not the recent date that just passed, like this week that was just that finished? Why is that?
Yeah, we probably have
Why
to
is it
look
that
at
not
each.
the?
No, I
No, I
just
mean even on the daily that you were on, just like the bull bar
yeah,
after our last PTM, so Monday.
I know, but this is also a good example. Channel, late
Okay.
strength, but this one has a double top. This doesn't all qualify all that much because we don't have much of a channel. So you said Monday, right? Here's Monday. What
No,
part
I
of
meant
Monday?
Monday on the daily chart. So like on the
Oh,
daily
on the
chart when
daily
we're
chart?
looking. Yeah, I meant why not just that one?
Well,
You
we
see
don't
the
have
bear bar,
you don't have a signal bar
the
here.
bull bar. Yeah. That's not this. You're not looking at that as a signal bar.
No,
What is that? April 7th? Okay.
no. This is a trading range bar. It's a doji. We want a reversal bar. We want a bar that looks like this, or a reversal bar, you know, decent reversal bar.
Okay. I thought that could qualify as well.
No, we don't have any here, honestly.
Bar 36, you don't like that either on Thursday?
This is not much of a channel. It's just one leg down.
Mm-hmm. Okay.
It has some two-sided trading in it, but everything has some two-sided trading in it. Sorry. Did you hear that? I heard it was.
Like very little, very little.
Yeah, it's you know, we have a whole bunch of younger kids here, and they love sports cars and, you know, loud bikes, and this was a loud bike. All right. Okay, so let's move on. Our next topic is trends. So we're going to talk about trends. Just want to remind you that for this series of PTM, I'm sort of bringing a bit more structure into the presentation of material. And you know, the major topic that we are talking about, different aspects of it right now, is major structures. So we talked about breakouts several sessions ago, and then we talked about channels, last session and beginning of this session, and now we are on trends. So these are all under the umbrella of major structures, okay? Okay, so let's see how much you remember. So what are the characteristics of trends?
The trend bars, and then higher lows and higher highs. Gaps staying open.
Or strong trends. All right, so let me write it down. So what did you say?
So I said trend bars, and then higher lows and higher highs, and gaps staying open.
Okay, so open gaps. Higher highs and higher lows. Sequence. In terms of, like, think about a trading day. A day that starts with something and then it starts to trend. What's that something? How does it start? Because after all, most of you are day trading.
Breakout.
Yeah, if we're looking at
Okay.
Yeah, if we're looking at day structure as well, that could be just the first few bars being trend bars to in that direction of the trend. So let's say bar one is a bull trend bar, bar two is a bull follow through bar that's also a trend bar.
Mm-hmm.
Phil, you were saying something?
Yeah, but that is not the very first thing that you would see on the
Breakout. Breakout. I just said like a spike.
Yeah, but that's not the first thing that you see on the chart.
Bar one is large.
Yeah, you're all correct,
Yeah.
but that's not the first thing.
A gap
open.
A gap up.
Correct.
Yeah.
Yeah. So, relatively a large opening gap.
But we don't want it to be too big.
Yeah, but you want it to be bigger than 10% or 15%. So something like 30% gap up, something like that. And then following that, so think about the day opens and it's trending. You usually get a gap, and then you get follow through. So as you said, spike, on the open. And then that spike also has that, all of those, relative strength or 10+2 characteristics. And it is usually not counter trend. So it is in the direction of the higher time frame. Those things increase the probability of it to control the entire day rather than be one of these, like, for example, bear trend for the last little while. Bars have tails above them. So that tail above is a trend that failed, or trend, bull trend attempt that failed. So usually that is also in the direction of the higher time frame. But anyway, so we have those. And then what?
Lack of
I don't know if
two-sided.
this is I don't know if this is the direction that you're going with this, but if it's, for example, it's on support. So I don't know if that would still be a higher
No.
time frame or not, but okay.
Well, obviously, but we are looking at more like easier things right now. So strong market control is what you would see as a result of all of those, relative strength stuff.
Lack of climax kind of behavior.
Yeah, lack of climaxes, lack of overlap. So as the bars go on, adjacent bars do not overlap one another by all that much. And because of that, then they can create micro gaps and open gaps. So
Another characteristic, Ali, is on the open. If you have a large bar and you take off, you don't come back and close the gap to bar one.
correct.
If you leave a gap in there, 90% of the time you're shooting up.
exactly. So that's a good point too. So open gap with bars 1 and 2.
One of my favorite things to look at is constant failures of the other side. So like lots of failed reversal attempts, 1 bar, 2 bar, everything fails, and the other side is constantly getting trapped.
Yeah, yeah. So I just want to add something here. Climax or big climax.
Ben just said it right now too. Pullback's not retracing a lot. So pullback bars just being 1 or 2 bars, not being 3 or 4, and also
Pullbacks
not
are
going below
small.
the prior bull bars. Yeah.
And short-lived.
So I call it the failure of the fade 1 system. If that happens, you've got a big trend.
Yeah, totally. If you cannot fade the direction of the first 1 or 2 bars and a scalp, that's a sign that it might be in a trend. That's correct. So I think we mentioned all of these. What else?
So strong market control, that's uniform bars as well, uniformity. That could be under that. But that's already in strong market control.
Yeah, you can say there is that, or you can say lack of climaxes. So bars do not become climactic, which is exactly what you said. And that is
all
correct.
tests, like all like breakout tests, kind of directional retracement tests work.
What do you mean?
Like in the sense of tests working rather than failing, like we talked
I see
about.
what you mean. Yeah, so yeah, sure. We might say that is included in this.
Yeah.
Okay. But that's a good way of thinking about it. To say, all right, we have tests result in trend resumption, so tests are working. Yeah, that is correct.
Yeah, or the flip side also, tests for the other side failing. So you have a good, let's say it's a bullish trend and there's strong support for the bears to enter, and it just goes right through it. Like tests completely failed for the other side.
Correct. Yep, that's right. One of the things that is a derivative of market control is that there isn't or no significant channel line overshoots. So the market is moving in an organized way and it doesn't really accelerate and overshoot the channel line. Because if it does that, then it's going to create one of these. And then when that happens, it has to pull back and come back down into the channel or sometimes reverse. But a very controlled trend wouldn't do that. We had a great example of it this last week in here. Okay, you see that as long as it is controlled, it's just going. And you don't have any overshoot of the trend channel line. But as soon as the channel line is overshot, even on this bar, there's a pullback. These 2 bars, there's a pullback. Then there's another overshoot here that immediately pulls back. So a sign of a strong trend is the organized move that it produces with, it's like a group of soldiers marching and there's some drummer in the back that's keeping the pace for them. So that prevents the channel line overshoots. Therefore, it doesn't become climactic.
Then there's also a flip side to that too, which is probably the hardest for all of us, maybe even you, which is when there are overshoots or there are climaxes, you expect, some kind of, response to that, and there's just no response. And those are just crazy days.
Exactly.
Yeah.
Yes, that's correct.
They're pretty rare, but they can be extremely dangerous if you don't let they can happen.
Yes, that's correct. So there are two things if you think about this aspect, the other one is the opposite side. So for instance, let me just draw it up, it's easier. Here's our channel. And usually in the case of trends, it's a tight channel. So we don't want to get overshoots, bars that do that. And in the process, we don't also want to get this undershoots, like the opposite, right? So overshoot of channel line. And the name for the opposite one, we can say undershoot of the trend line or just break of the trend line. But both of them happen. So when you have a trend, especially the trends that are strong, they do both of these things, but they do it not to an extreme extent. They do it in a small manner, small fashion. So overshoots and undershoots are small. But when they happen, so we can say no significant channel line overshoot and no significant trend line breaks. But also when they happen, okay, when happens, result is brief sideways, then trend resumption. So you want that sequence as well, because they happen. They're going to happen. They will happen as a result of, buying and profit taking, buying and profit taking. But whenever it happens, you want the response to it to be brief, sideways, and quick trend resumption. So let me add the quick here. Quick trend resumption when it happens. And that is the emotions that come up is like you're sitting there watching this thing and it's constantly pushing the price higher and higher, and you're thinking, oh, it's too high, I don't want to buy here. It's going to pull back. And when it pulls back, it doesn't sort of give you the chance to really enter the market in the way that you want to, because the pullback ends, sooner than you expected it. It doesn't go as deep as you want it. And then if you don't enter the market, it's already going to go higher. And then if you don't participate, it's, oh man, I lost another chance. So there's always this constant feeling of being pressed to buy expensive, but expensive is not expensive because the market's going to be even more expensive 20 minutes, 10 minutes later.
Could you put a lot of these in the general category, and probably some others, of failure of failures? So you expect a completion pattern to have some kind of response, and it either has very little response or basically no response and just continues?
The pullbacks, sort of, yeah. You can maybe think
No,
about
like
these.
say you have like a parabolic wedge, or like a micro top, and it just continues right through it with almost no response from the other side. So
Like
that would
this
be a
day?
failure of well, that day until bar 36, yeah.
So what do you mean by failures of failure? Like this bar failed, reversal. Is that
Yeah,
what you mean?
exactly.
Okay.
Yeah, exactly.
Yeah, that's fair enough. Now look at this. This is actually a very good example. What is the end result of all of these things? Like, if you want to explain it to a, I don't know, 8-year-old kid, what would you say to him? Because if you say all of that, you're going to lose him. He's not going to be that patient. You just want to give him one thing for him to remember. What would that thing be?
More in that direction. So after sideways, more in that direction.
No, not really. You would probably tell him, look, if this gets parallel to the moving average, just go in that direction. If it's down, just sell. If it's up, buy. Don't think too much about it. These two lines should be parallel. Okay. provided you're using a moving average on your chart, because you can't trade without a moving average. So trend line.
Yeah, I wanted to say EMA, but I thought you were gonna say like no, it's without EMA.
Parallel to EMA. And then there's one more thing here. And that is,
I don't know if okay.
Yeah,
I don't
just
know if this is that thing, but do you want pullbacks? So in strong trends, you want pullbacks. Is that
yeah,
correct?
you want pullbacks, exactly, because if you don't, then it becomes a huge climax and it's going to reverse. So you want a sequence of 15 to 20 bars not touching that moving average. Or you can say it in a different way, many bars with moving average gaps. Okay, so there's a
Ali?
gap here. Yes, please go ahead, Bill.
Yeah, it always seems like by the time you get to 15 or 20, the trend is almost over.
That's correct. At
And
least you're going to
so,
get a pullback. Yeah,
yeah,
most of the time. Yeah. Yeah, but then there are consequences for that. And those consequences are interesting, because if you diagnose it correctly, then you know what direction to trade. And most of these things, when they get that strong, they also have second legs, and the second legs are sometimes tremendously big and last more than a day. So it is not the immediate action from it. It's also the understanding that, okay, here's what we're going to do. This is the agenda for today and tomorrow. Because
Tuesday
of that,
was a good example.
Tuesday, yeah. Because of that, it's really important to sort of have thought about these things so that you know what to do. Yep.
You get
You
those
see
20
that
bars, but then
yeah, you see that as soon as this gap starts to increase and it doesn't go parallel, it starts to pull back. This part, mostly parallel. This part is not, and then immediately pull back. Strong trends produce channels that stay parallel to the moving average. This one too, when it curves down, starts to pull back. On higher time frame, if we go back to when we had a strong trend, these are not all that great, but they have sections in them that are parallel. And then when it is parallel, usually the moving average is a good support. As soon as it deviates, then it has to come back. Deviation, pull back. Yeah, this one was very
Mr.
good.
Afshar,
Yeah.
when
Yeah,
you're
go ahead.
measuring the distance from the EMA, are you measuring it from the close, or like where are you measuring it from the EMA to see like how much
In the bull case,
it's
from the low of the
deviating?
bar. In the bear case, from the high of the bar. You want the bar to not touch
Okay.
the moving average. So if it has a tail that crosses over, then it's not a gap bar. Gap bar means there's
So you're not doing it from the close.
no. Gap bar
Okay.
means there's a gap between the entirety of the bar and the moving average. So no part of it is touching. Okay, so now there is an observation here that is also important, and that is counter trend limit orders. Sorry, I messed it up. Limit orders do not work. Okay, so they either don't work or they are not really profitable. Do not work or are not profitable.
That's actually one of my favorite ones because it
Mhm.
feels the most objective. Like it's a
Mhm.
fact.
Yeah, all that much. Try it. I mean, you use a paper money account and try this, because if you try it and you see how hard it is to do the opposite and make money, then you have an appreciation for it. And then when you see the other side is doing it and they're not, really making much, or the opportunities are not great, because let's go back to that chart and use it as an example. So for example, you want to buy below that bar. Okay, counter trend buy. We have a pause here and another pause here, and the bar got triggered. We went above it and then we are pulling back. We are actually resuming down. So we want to buy below that bar. So what are you getting? Well, first of all, the market runs you over and it immediately goes against you by a lot. That's one of the signs. The other thing is, once you feel that you're trapped in that trade, let's say you're scaling or now you're reducing your exit order from above the bar to, some lower price, it keeps pushing you. So you have to keep pulling that order down, hoping that eventually you can even exit break even on that entry. And then if it is still a bit optimistic, like, for example, you would think, all right, so this bar is a trading range, we just broke out, we have to go back to some place in the tail of that bar, and you have your order here. It approaches, so you're optimistic for a moment, and then it doesn't get to your order, and then plunk, drops down again. That is what's happening to the other side. They cannot really trade counter trend all that easily. But when the market's in a channel, look back here. So somebody sold that breakout. Easy profits. Somebody sells that breakout or sells above bar 60. Easy profits. Somebody sells above that inside bar. Easy profits. Okay? So you see how different these two are. In here, counter trend trading is fraught with anxiety and, the need to constantly, go lower and add to your trade, for example, scale in, and then the pullbacks do not really overlap all that much. So you have to be really, really fast to get out. But here, it doesn't go against the trader all that much and immediately gives the trader profits. So that contrast exists between strong trends and everything else that is in the channel. It's very important to have felt this. So highly recommend that you actually paper trade it and see what happens. Also, in terms of dollars, if you look at, what was in it for somebody who bought, like who participated in the direction of the trend versus somebody who was being smart and trying to fade everything, you would see that the faders are not ending up with all that much money, even when they do it really, really well. And that's because momentum is against them. And then the other thing is, so the action itself is not profitable, but then the opportunity is also not there. So not many opportunities to trade counter trend. Because if it is in a channel, almost every other bar you have an opportunity to trade counter trend. But if it is not in a channel, or the channel is very tight, you don't get that much opportunities to begin with. Like look at this one. You want to fade. There is no structure. There is nothing in here convincingly strong enough to let you actually start buying. But in here, there's plenty, right? So lack of opportunity is also a very good sign that, hey, this trend is strong. It's not giving the other side any room to move. The other thing, as I explained, is there is a sense of urgency. So you want to be in that trend. You want to get a pullback. The pullback never comes. That impatience, that urgency is felt. Now, that urgency might be on the part of a trader who cannot trust the momentum and just jump in. But you also see it in the bars themselves too. Like, for example, let me expand this a little bit so that we see the bars. There's urgency to sell. There are not too many pullbacks. Tails on top of bars are small. And we don't have a shaved bar here, maybe this one. But a lot of this sort of trends also have a lot of shaved bars. There are no tails in the opposite direction of the trend. So there is a sense of urgency. Look at, for example, 27. How far did it pull back into the bar? It didn't go above the bar. It didn't go above the closing price of the bar that seemed like, a buy signal bar here, bar 25. It fell short of both. That is a sign of urgency. So everybody wants to sell. Every little pullback is a reason to sell. And that prevents the pullbacks to become large and, really go the distances that most traders are comfortable entering. So there is competition to participate in this, and that limits the distances that the market can pull back. Okay. So that sense of urgency limits pullbacks as a result of it. Okay, what else? What do you think we have missed?
You could also add, this goes along with counter trend limit orders, but if you extend that to stop orders, that can give you some sense of how the trend might be developing into maybe more of a channel or maybe even a broad channel. If this stop orders, if they don't work, then it's a tight channel, and if they start to work, or at least for a scalp, it's like a regular channel. And so I like to look at that too. I just really like to look at how the other side is doing in all ways.
Yeah, sure. Yeah, so maybe I can summarize it. Please correct me if I'm wrong. So there are good, and I can say easy stop entries, right?
Yeah, that works. I was thinking the other way. I was thinking counter trend stop are failing just like limit orders, but that works also.
So this is with trend.
Yeah.
And so stop entries for reversals. This is counter trend. Fail. Yeah, and that's correct. The other thing is, so when we are saying they're good stop order entries, that means they get signal bars that are manageable, that are clear. There's you don't have to read too much into the lower time frame. The signal bar itself is good. Like you get a high 2, for example. Everything is great for the high 2. It has its 2 legs. The 2 legs look like legs in trading ranges. Bears don't have anything. They haven't gotten any follow through, and The high 2 signal bar also looks great. So stuff like that. Those are present. Those are a function of one side controlling the market. So the pullback structures, the setup for the pullback looks great. So I think that is it. You might add something here that we talked about it, but sometimes in a strong trend, like, you know, I'm showing you this, and we talked about this quite a lot, but this is really just a vacuum move intraday. So if you step back and look at higher time frames, you don't get this all the time, but you get strong trends. And strong trends, one of the things that they exhibit is that generally everything that goes against the trend fails, okay? And that even includes spikes against the trend. So it's worth mentioning here that reversal spikes against the trend fail. What is the minimum definition for a spike? So because you have to start working with the minimum definition, because if the spike against the trend is going to fail, it's probably not going to be something that goes prolonged and it's easy to see. But it is at least adhering to the minimums. What's the minimum?
2 bars. 2
Yeah,
bars.
exactly. Yeah. 2 bars, 2
Two
strong bars
higher
and 1
lows.
drop. Yeah. So minimum spike, 2 trend bars back to back is going to be a minimum spike.
So for the minimum, it needs to be trend bars, right? Or even if it's kind of just 2 higher lows or 2 higher highs, that would be a spike too. Okay.
No, you want it to be, you want the 2 bars to show you that on the lower time frame you're having a trend. And if it's part of it is a trading range, then it's a trading range breakout. So 1 bar is a trading range, next bar is a trend bar, then it's probably a trading range breakout in the opposite direction. It's probably not going to work, but you actually want a spike and you want two trend bars back to back. But I hear you. You mean, like, you know, the lows don't go below the low of the prior bar, but that is not enough. Okay, so that's it, I guess.
So, Ollie, before you continue, a couple of months ago, there were a bunch of people in this group that were really struggling with understanding how we transition or even begin in a trading range, and they were asking for ideas for, you know, how to be more objective about or more adept at identifying when trading range behavior is starting to begin. Would it be overly simplistic to say if you just took this entire list and flipped it on its head and said the lack of all these things would be a very strong indication that there's trading range behavior?
Yeah, you can say that, definitely. Yeah.
Like if you gave every
Go ahead.
If you gave every one of these factors, or not everyone, but, you know, obviously some of them don't make sense, but a majority of the obvious ones, a score of, you know, 1 to 10, and 100 would be a perfect trend. A 0 would be like a perfect trading range.
Yeah, you can do that too, but some of them are a bit.
Yeah, some of them don't work.
Some of them are a bit, you know, discretionary, and that's why I created that 10+2 rule set, because that is not very discretionary. It's, you know, it's either there or not.
For example, like counter trend limit orders do work, stop orders and the counter trend stop orders do work.
Those are very important. Yeah. I think that is probably the single most important hallmark of a trading range being in progress. Like a leg in a trading range is there, and now it's going to reverse or go sideways. On that note, we can talk about a homework here or two. So number one is study, this is going to be very general, the above factors. And the goal here is gaining confidence to jump in, to say it in the smallest number of words possible. So you don't want to be sitting there with anxiety and it's, oh my God, I missed this trend. Okay. And when you're training yourself to be able to jump in, one of the things that you want to do is to time your jumping in. Okay. Because if you wait too long, then it's going to go and you're going to miss it. So what are the minimum requirements? How many of these things should you see there to allow you to just hold your nose and jump in? Okay, so that is really important. And that study should give you that. Like, you know, how many of these factors do I see? And how many of them can I detect early so that I can participate and benefit from the move that's in progress? Okay, so that's one thing. The other thing is study the role of pullbacks in general and profitable counter trend limit orders. The role of these things in limiting the trend. So basically what you want to do is look at enough examples and see when the trend starts to get into, you know, price action that is conducive to counter trend trading and limit orders start to work. Now, is that trend is going to continue even further and further and further, or it's going to turn into a trading range and go sideways and at least pause for a while before it resumes again? This is also important in building that confidence that once you see several pullbacks, it's better not to participate in that trend anymore and look for now, you know, either a reversal or let the market consolidate for a while and then buy later to get the next big leg up. So these are, I wrote it in very general terms, but you can customize it based on all of these factors. You can research all of them. You can research 2 or 3 of them, but the goal here is 2 things. Gaining confidence to participate in the trend as soon as you can, and then the opposite of that. So when is the time to not participate or be careful to take profits early and maybe even start to join the other side and start fading. So these 2 are good complements.
And Mr. Afshari,
Yeah, go ahead.
For you, is there one thing or 2 things that kind of just, when you see these things, you're like, okay, this is a trend? Do you think like that? Because you say like minimum victory analysis, or it's a big list. I'm just trying to think like for yourself, what would be the 1 or 2 things that you're like, okay, this is present, probably a trend?
I mean, all of them are important. The more you see is more important. But I think the easy way of looking at it is that, you know, I said again, relative strength, that 10 plus 2 factors. That is a big part of it. The other part is how what you see on the screen in front of you relates to the context of the the bigger chart, the 1 or 2 time frames higher. Because sometimes you see very strong trends, but they are really not strong trends. That's the last few bars of the higher time frame that's testing support and resistance, and it's preparing for a trading range. It's just that because that chart is doing its thing, we see it as a very strong breakout on the lower time frame. Every good trader has always part of their brain working on context on every single bar. It's not like the context is all forgotten at some point and then you think about the context later. You see everything in the light of that context. And that's the hard thing to master for a lot of developing traders, because it's overwhelming, really. You have a lot of small factors that are immediate, regarding the chart, the bar in front of you. So you have to see all of them. And then you have to sort of put all of that in the context of the higher time frame chart to understand what that is doing. And that makes it difficult. But realistically, every good trader constantly thinks about the event response of the higher time frame and how it sort of links up with the chain down to the time frame that they're trading. Now, I'm saying it in this way, but realistically, look at the chart. Do you need much to trade? You know about my breakout research. So you get breakout and follow through, or you see a leg that's fairly strong, just expect a second leg. So you don't have to really participate in all of this and swing trade, but you can trade it in sections and stop doing that when you have traded it in 3 sections. That's probably as easy as it gets. Like, this is a strong, expect one more leg up. And that leg does not even have to be symmetrical. It can be just half of this, or one, if it is very large, even 1/3 of it. See this, expect one more leg. That could be just 1 bar, and this did that. So went below the low of the reversal bar and then reversed up. So it did the minimum. This is a good contrast, because on this chart at this point, all of that sell-off needs one more leg. Here's one more leg. Okay. The leg itself needs one more leg, but that could be brief because we have, 3 or 4 bars. So 3 or 4 bars, you might get one more bar to about 3 bars. But the bigger chart had a tremendous breakout the day before. So all of this needs one more leg up. Therefore, all of these things are probably going to become pullbacks. And that's what I mean, that you see everything referencing the bigger picture. Okay, so not too much of an expectation for this. But then when you see the reversal, so let's say you were looking for a test down that moved the price this much to here and it failed. Now you have the other side. Don't rely on that stop, cancel the stop, close the trade, take the loss, and then buy again, because now there's going to be one more leg in the new direction going up, which was supported by the bigger event anyways. And so on and so forth. First test of the moving average, you get, if this is a strong trend, the bear spike should fail. This is the example of the, where's the whiteboard? Of the last thing I wrote here. Minimum spike, two trend bars. 2 trend bars. 2 trend bars. Okay, when spikes are failing, that's a sign that the trend is strong. But then this shouldn't have happened in a trend. And that's why that homework is important. You have to study it to see when you can start fading. So there are probably sellers above. Days overall bearish, so it's going to be a trading range day. And you see what happens. They sell above it and then sell above the next bear bar. One more leg down, and then 2 or 3 more legs down. But then the 2-legged move is always present. So this will have one more leg. This is very strong, probably get one more leg. Could be just 1 bar. similar to this one, 2 or 3 bars, 2 or 3 bars, expect one more bar at least. This will have one more leg. It got several more. And then this one is fairly strong move. The market below the moving average, always in short now. Bad buy signal, so probably get one more leg.
Ali,
Yeah, Phil, go ahead.
that leg from 57 to 61, would you consider that a leg 3?
50, this one?
57 to 61.
Oh, this one.
Yeah.
Yes. But the thing that you have to realize here is that this was the very first break of the bear trend line, major bear trend line, that trend line. So this belongs to both bulls and bears, but it went fairly high up, and it went above a major swing point that we talked about last time, and it is large. So although this seems to be the first leg up, complex leg up, it's also part of the bear structure. Therefore, you can count it and then look at what happens next. So what happens next is this leg, which is also very strong. There are basically no bear bars in it. We have dojis, but we don't have bear bars in it. So this might now need a two-legged correction or two-legged piece after it to complete it. Is that the two legs, or is this the two legs? At the time that it is being built, you probably don't know yet, but this is still too strong. Very likely to go sideways rather than down. But I think at this point, it is complete. So either 1, 2, and 3, or reversal, then 1, 2, and 3 here, or 3 here, depending on how comfortable you are shorting at that point. So both answers are correct. It's just that wedges, multi-leg patterns, a lot of time start before the prior sell-off is over. So this is going down, bulls are buying, that they create momentum. That would be the first leg up. And sometimes it is very brief too. It's not even this big. So it's just one bar, and that bar was the first push up. Sort of like, to some extent, you can say here. Right, we went down, market went up, went above that, but this was down. And then we have another down with the reversal. So at this point, you have double bottom bull flag, which is a trend resumption setup, but the leg down is fairly strong. And we have a bear breakout below that double bottom that fails immediately. So it is a wedge. It's a wedge distributed in this manner. Down once, down twice, down 3 times, failure and reversal. And the last piece of it is also a 3 push pattern, 1, 2, and 3. So the wedge can start before the bear leg, appears on the chart. Same with this. The wedge up can start, before even this is finished. And I don't want to get too much sidetracked, but market went up here and then down. Market went up here. And then there's a bear bar here, so you can say double top bear flag. But then we get one more breakout and then it fails. So now it is a wedge. But the 3 legs are really based on this one. So you can count it from here too, say 1, pause 2, pause 3. But it is sometimes easier to see what did bears had as an entry for trend resumption, and then what happened to it. If it was a double bottom or a double top, and then it fails and reverses, that's equal to a wedge. And that's why I said this is partly also the part of the bear price action So you might want to wait a little bit, because if it is part of the bear structures, this part is finished. Now we have a new thing. That's the new thing. It's remarkably different from everything else that bulls had before this. So this might be a reset. And if it's a reset, it needs a two-legged move itself. This is too small. So maybe you need some bigger bars. And then look at it as now bulls, the pattern that they had is complete. It's either 3 legs or 4 legs compared to the bigger picture. But then it becomes even higher probability at that point for a correction that tests, deep enough and sometimes fast enough to be worth trading on the short side. So I hope that answers your question.
Thank you.
Sure, no problem. Okay, so now that we have studied this, it's equally important to do the opposite as well. So that this gave us an understanding of trends, or I might say legs in trends. And therefore, the opposite is going to be legs in trading ranges. Which is the exact opposite of that, right? So what are the factors? First,
Overlap, trading range bars.
Yeah. So if you,
that was
yeah. So if you want to just oversimplify or generalize, we can say lack of market control. And then we can expand on this. Lack of market control. So there is no strong control. One side is controlling the market for 1 or 2, 3 bars, then they lose control. The other side controls the market for 1, 2, or 3 bars, so on and so forth. So what was the next one you said?
I said overlap and lack
definitely.
of body compared to the bar.
Overlap, trading range. So trading range bars. So more trading range bars than trend bars. If the market is in a trading range, look at this part, compare it to this part, you will see that trend bars are few, and there's an over-dominance of trading range bars. Bars with long tails, small bodies, bad closes, failed breakouts, all of those things. Okay, what else?
Swing lows are getting broken. So let's say there's a swing low and a swing high, and then the other side goes below the swing low. So it's not making
necessarily. It can be a
higher highs and
channel.
higher lows.
No, yeah, it can still be a channel. So in here, it's still progressing quite well. So higher high, higher low, higher high, higher low. So it's still doing that, but it's also a leg in a trading range. When it does break a major swing point, then it can convert into a more horizontal trading range. But the leg in a trading range can go in one direction and still perform like a trend, higher highs and higher lows, but it is not a strong trend anymore. It's a channel and it's ready to reverse. I think the thing that you should have mentioned probably right off the bat is, actually you did when you said overlap, but overlap can exist between bars, and overlap can exist between tests of swing points. So breakouts fail, and breakout gaps get closed. That is one of the important hallmarks of legs in trading ranges, and that is the factor that allows the counter trend trading to start working. Okay, so maybe we can say no consecutive OHLC trending prices. You see, in trends, all the 4 prices, open, high, low, close, start to trend. Now look at this chart again. Open above the prior open, close above the prior high and close, low above the prior low. So OHLC trending perfectly between these 2 bars. It starts to diminish here, so not all the 4 factors are trending because closed below the high of the prior bar, but closed above the close of the prior bar. So to some extent, it is still trending, but not as perfectly as it did the bar before. Here, OHLC is trending, especially in this stretch. Every bar is trending OHLC. But if over here, no, over here, no. Not every bar is doing that. So this gets damaged as part of the trading range behavior. What else?
Bad sell signals work? Bad reversal signals work?
The look of the signal, like weak signals?
Yeah, right. So let's say we have a micro channel and then we expect it to pull back and give us a second leg, but doji bar gives us another leg in the opposite direction, which is not expected. Like low probability events are not as low probability.
Yeah, like breakouts start from weak signals. This is what you meant, right?
Yes.
Yeah, exactly. Yeah, that's a good one. What else?
I think in general, kind of what we were talking about a little bit earlier, if you flip the trending behavior on its head and say that orders for both sides, entries for both sides work. So limit, you can take limit orders on both sides. You can take stop orders on both sides. You can fade on both sides.
That is correct. There's one little thing here with respect to this overlap factor, and that is tick gaps close. I think, is there one there? It's so hard to see them. I have to put an indicator on it. But usually when market's in a channel and it gets two-sided trading, you get, for example, you get a reversal bar and the market jumps and there's a tick gap, but then immediately comes back and closes that gap. But when it is trending, tick gaps stay open. Do I have that indicator here? Just give me 1 second. I see it. No, I think I removed it from this chart.
I wonder when the volatility is so high, like it has been, how, the movement is so big. I mean, a little tit gap, how significant?
Go
How
and
much
do a
attention
study on it. It is still significant.
It is insignificant in
No,
terms of.
It is significant.
Oh, it is. Okay.
Yeah, it is. I mean, I hear you 100%. When the market is
I
so
have to
big,
scale. I'm just looking at that trend right there that we've been talking about.
yeah,
I had to scale it so much to see
I know,
if there was
I know. And that's why I wrote that program, because it was in a similar market and it was so hard to see them. It gets blended into the bar and it's impossible to see them. But they're still there, and if you extend the tick gap, like put a line on it, you would see that they get tested and they are actually quite reliable support and resistance. And they're invisible to most traders. But you know, those tick gaps get tested and they get closed in this type of a market.
You could also take the EMA, flip that on its head and say, you know, rather than in parallel, it's a flat EMA and it trades on both sides of the EMA.
Not always, because here's a
Not
channel.
always, but well,
Right.
yeah.
Yeah, but you get more frequent tests of the EMA in a lot of cases.
Like if you look at Monday,
Yeah,
that's
yeah, exactly. Yeah, well, that's the trading range, but a leg in a trading range that forms a channel.
Oh, I see. Okay, sorry.
All right, it still goes to the moving average quite a lot. So it doesn't produce those very long stretches of bars that are not touching the moving average. I mean, this was still quite strong, but let's see if we can find. Yeah, so this could be an example. You know, it has the same kind of characteristics, bad follow through. You get 2 bars, but not 3 or 4 bars. Pause. And then there are more frequent tests of the moving average.
Oh, another one is tempo. So tempo phase work.
Yeah, exactly.
I think the biggest ones is just the overlap, and yeah, that's the biggest one, I think. Just if it's overlapping more, that's the trading range. If it's less overlapping, probably not a trading range with the bars and the swing points.
Yeah, so short. And that's another one, tempo cycles. So in trends, you usually get tempo that gets stretched to 4 bars, 5 bars, sometimes 6 bars. When it's a leg in trading range, this tempo cycle is probably at most 3 bars and sometimes even 2 bars. Look at this chart. 2 bars, pull back, 2 bars, pull back, 2 bars, pull back. So the tempo cycle is short. But when it is a trend, tempo cycle is not short. So you get 4 or 5 bars in one direction. That's one of the major differences of legs in trends versus legs in trading ranges.
How about a lack of uniformity of the bars? Would that be a good one?
Yeah. So where's my pointer? There. Sorry, I have to reset this. Maybe minimize it. Okay. Lack of uniformity.
And did we already say climaxes?
Yeah. Trend bars become climaxes and reverse to close the gap, those breakout gaps. Basically, a leg in a trading range is a collection of climaxes, just like the trading range itself. Trading range, so let's just do a little schematic here. A trading range is a collection of climaxes. So a trading range usually expected as a horizontal trading range that does this. Okay, each one of this is a climax. Buy climax, sell climax. Buy climax, sell climax, buy climax. Now, if you take a magnifying glass and move in to take a look at the legs themselves, now the leg is a bull leg, so it's a trend. But if you put a magnifying glass on this and take a look inside, you would see you know, a collection of climaxes there. Bear bar, let's say. And then it reverses. Okay, so 1, 2, and 3. Okay, so this is all that first leg in the trading range. And then it reaches the resistance and reverses. But the structure of the move up there, most of the time, not always, but most of the time, it's also a collection of climaxes. So when you see this, when you see this on top of a trend, it's probably the end of it. Yeah, sorry, go ahead.
No, I was just thinking about when it's not at the top of a trend, but just a fairly established trading range, or there's clues that it's going to be a trading range. Is the reason you see those climaxes so often because most traders recognize that it's trading range and they want to wait until it gets to a buy zone or a sell zone, and that creates a vacuum to let it get to that area so that they have a good risk reward?
Yeah, that's the dynamic, right? Yeah, exactly.
Okay.
So, you know, if a fast move is really just a vacuum move. So nobody participates until it is at the price that they want to participate. And then when they do participate, like sellers coming to sell, bulls wouldn't buy because they're not betting on breakouts, they're betting on reversals. And that, you know, takes over. The trend is not there anymore. So the 80% rule is flipped. Now you have to bet that everything is going to fail to break out. Therefore, if it is on the top and you're participating on the long side, you wouldn't bet on the breakout, so you will close the position. And the bears who want to sell, they start fading bull breakouts. And that's the sort of, you know, two-sided trading that we sometimes see near the tops and bottoms of trading ranges, because one side is taking profits, the other side starts to, you know, quote unquote, nibble, start to sell small and then add to their positions. Because this line is an approximate area. It's not a, you know, geometric line, which is straight and has no width. It has quite a width. And because of that, you know, you get the, you know, let's look at the chart. So if this is a leg in a trading range and it's going to reverse, here's resistance. You see the effects of profit taking. Bars are not closing on their highs. There are dojis, tails above the bars. That is mostly bulls taking profits who bought, you know, lower. And then bears start to sell. So they are looking for something to start selling. And that's usually a trend resumption pattern near the top. Here is that, you know, pause bar near the top. Pause bars are trend resumption. Pause bar, trend resumption. Pause bar, trend resumption. But when it is near the top of a trading range, pause bar is a reason to start doing the opposite. So sell above, bet on the failed breakout. So they sell. And if they're looking to hold the position, I mean, this is the end of the day, but just theoretically, if they look to hold the position, they sell and sell higher. Because the top of the range can be here or it can be up there, but it's probably going to reverse. And if it reverses, where is it going to test? At least to the first area of pullback, spike, first pullback, trading range. So all of this is the construct for the bears to look at. So they sell and sell higher, looking for the market to test to 57 over here. That was the very first pullback, spike, pullback, channel, beginning of the channel. But nobody knows if it's going to reverse here or it's going to reverse from a slightly higher price. So the effect of both of them, bulls taking profits and not participating, bears start to sell and scaling it higher, creates that final piece in a trading range, which is even more two-sided than everything leading up to it. Most of them are like that. If you look at bear leg, becoming a trading range. And then before the reversal happens, you get more two-sided trading. This is more common than this sort of a reversal, sharp, leg in a trading range, sharp reversal. This is less likely to happen. Most of the time it's like this. So those things are present when there's a leg in a trading range. Now, thinking about what's going on through people's minds when this thing is happening. Did I mention gaps close? I think we should.
Yeah, with overlaps.
Yeah, okay, so we wrote the gap closures. We said that bars don't look good, excuse me. You have tails on bars. Most bars are bars that belong to trading ranges, so there see more trading range bars. But beyond this, especially for the beginner, there's a sense of frustration. And that replaces the sense of urgency that exists when there's a very directional move. You feel that you're going to miss the trend if you don't get in the market right now. In this case, when you get in the market, it immediately does something to frustrate you. So, oh, there's a reversal, it doesn't go. There's a breakout, it reverses. And there's always something that frustrates traders. And finally, I think.
Yeah. There's also the sense of FOMO, the sense of urgency is in trading ranges too. But as you said, it's just once you get in, then it's frustration if you're just jumping at it.
Yeah, lack of consistency is the other one. Everything fails. You get a pair of good bars, next bar is completely reversal. Okay. Reversal and follow through. Doesn't go all that much, immediately closes the gap. There's a sense of frustration. Like, things are not working. Two good bars, reversal bar, gap closed. High one, entry bar. It doesn't go to your target immediately. Pauses. So those are all the signs in trading ranges. So I had lots of homeworks this session. So study the above factors. To gain confidence in estimating. Leg in trading range is about to reverse. So that's one aspect. The other thing is use the above to trade with limit orders. And that means the 80% rule in TRs, right? It's like a switch. And really, there is a switch. So if the market is trending, you switch to 80% of reversals are going to fail, and you trade like that. So you can still trade with limit orders. And then if it's in a trading range, you switch to this, 80% of breakouts are going to fail, and you trade like that. But still limit orders. But the enabler basically is all that we talked about here in the session. So you see characteristics of a trend. You can still use limit orders, but you have to bet on pullbacks and reversals to fail. And sometimes you have to be very aggressive. Like the slightest pullback is enough to fill the limit order. So you're not looking for a big two-legged move, slow and, with enough time to think. If the trend is strong, you're buying in the buy zones of the bars and even buying in the sell zones of the bars in the bull trend. Because momentum is what makes the sell zone to fail. But as soon as you detect the signs of two-sided trading and limit orders start to work and all that, the stuff that I talked about here, you look at, how the leg looks like. If it is still young, like, it has, potential for one more push up or something like that, you can wait for it. But even then, in most cases, and please study this, late legs, you can sort of fade them with kind of impunity because the probability of the market to reverse is so high that it actually makes perfect mathematical sense to do it. Late leg breakouts have something like 85% chance of reversing and being profitable, which means the probability for the trend to resume and not do that is only about 15%. That is very good odds for trading. So please study that, because everything that I talked about in this session, if you do your homework and study it well enough, should really get you past the barriers of indecision and fear. When you have a 85% chance of winning, you have to take the trade because you're going to win 85% of the time. And that means 15% of the time, 20% of the time, that trade becomes a loss, but only temporarily, because if something that has 85% of chance of winning turns into a loss, then whatever turned it into a loss has 85% chance of getting a second leg. So you take that loss really quickly, professionally. That means, this is the cost of my work and I'm going to accept it. So you take that loss and then look forward to the next leg in the new direction. So it's like you either make money now, or if you take a loss, you're going to recover it and make money 20 minutes later. So a lot of the fear associated with trading will go away, but it is predicated on doing your own study and research. That's really, really important. All right, so I think this is good enough for now. Want to talk about the higher time frame? But
Sasha, just one thing.
Yeah, sure, go ahead.
Yeah, I think the problem that developing traders get is that they're trying to look for 100%. They say, okay, if this happens, it's 100% trend or trading range.
No, we don't have that.
So then,
actually, thanks for
it.
mentioning it, Castro. Thanks for mentioning it, because there has been several research on how people understand probabilities, and the outcomes are, I've read the findings, and all of the ones that I've read, it's pretty much the same thing. So if it is the range of probabilities from 0 and at one end and 100% probability on the other side, when people are thinking about probabilities, most people, like the human beings are not good with estimating probabilities at all. So if you find it challenging, it's in your genes. Don't worry about it. You just have to study a little bit more. So human beings think about probabilities as yes or no, okay, or 100% or 0. But markets never operate on the basis of yes or no. Most of the time, they are about, so if this is the 50% mark, most things are in this range. So let's say 40% to 60%. And rarely there are, really, really high probability things that happen, but even then you usually have something that helps it, like, you know, there is a higher time frame reason, there's something else. So that probability curve is sort of I try to do my best, but it's not going to look perfectly, sort of like that. So it is very big in this area. And then if you think about the, you know, bell-shaped curve that approaches that, you know, zero, this is the zero line, the zero line really closely. This doesn't approach the zero line closely. It stays above it at a fairly high distance. And that means low probability events happen in markets more frequently. More frequently. Okay, so stuff like, you know, a 15% chance for something to not work happens more frequently than it's supposed to. But you have to study it for yourself to really gain confidence in it. And then hopefully the intimidation goes away. You have to do enough research and study in a structured way, just like, you know, the way I talk about it. Look at these factors, look at each one of them, count the number of trades. You have to do enough of them, you have to see enough to convince yourself that, you know, what Ali says actually works, and these are the numbers because I've proven it to myself. And then at that point, there's no reason not to take the trades, because if you can convince yourself with mathematics that things work, then your job is to take them. As a trader, that's everything that you do. You know, you take either high or low probability trades. If you take low probability trades, you're looking for a swing or a trend or a measured move, size of a move. If you take high probability trades, you're looking for a scalp. And you adjust it based on the market in front of you and market cycle and stuff that we talked about. All right, so let's look at this chart. So monthly chart, we are not even at the middle of the month yet, but let me see. So Friday was the 11th, and we have more than 2 weeks left of the month. So the middle of the month is next Tuesday, 15th. Therefore, this bar is not even half done yet. But do you remember how it looked like last week?
Yeah, it was big near the bottom. It was a breakout signal at the pain part. Yeah. And do you remember what I said?
It's exactly what you said. It would be coming back up. Can you tell us where it's going to be next week? Because you've got a pretty good record here.
Okay, thanks. Yeah. Well, that's about the weekly chart. But so far, we're talking about the monthly chart. So we closed the gap above the old all-time high for the next time because we had tested it 2 times here. And this was the next time. And then this line was important, as you remember. I also draw it on the end of the day chart time mark. And I said this was important because it was a low probability event that shouldn't have happened, but it did happen. And that is, we had the 4 bars down bear macro channel here. And usually you don't go above it and go past it. You usually go above it and test back down, or you hesitate and then go above it. This didn't happen here. We just crashed above it and, you know, continued going. As you know, this little tail here that's overlapping the top of the range, in my opinion, is not important, because this is the monthly chart. So if you're selling above the swing point there, you're looking for a profit. What does the profit look like on the monthly chart? Well, it probably goes a little bit lower. It has a bear body, something like that. Because if a trader is trading this chart, monthly chart, they are making one decision a month, right? That is what it means. If you're trading the monthly chart, you make one decision a month because there's one bar per month. So they sell here. What do they get on this month? They get a bull breakout bar. Okay, so that trade is already in trouble. Next month, there is no reason to sell again because now you have breakout and follow through. So if the trader was not nimble enough to take the break even test here, which was very quick and short-lived, at this point they have to take a loss. And that's why the next bar has a sort of a shaved bottom. Look at the low of the bar. It's 51.84.5. And the open is 51.86.5. So only 2-point tail on a 251-point bar. Basically not much tail. Sign of urgency. And I guess a lot of it comes from this, that the breakout above the bear micro channel got follow through. So now whoever sold there has to close the trade. Therefore, that little tail that overlaps on this chart is not all that significant. Not many people had the opportunity to take that trade off the market at that point. They're looking for this. So this is now giving them that opportunity. Now, nobody, I think, is going to scale in 1,000 points and wait for this to come back and test. I understand that. But you need a methodology to explain the market behavior, and this works. So that's all that you need. You need something to be able to explain the market behavior and draw reasonable, repeatable conclusions from it with good accuracy. But it doesn't have to be practical. On a intraday chart, it's practical because you can often do that. It's not 1,000-point scaling. Sometimes it's a 50-point scaling in. Some traders do that. I know some of them, as crazy as it might sound. But because markets are fractal and the lower time frame observation is also applicable to the higher time frame, that same methodology works here too. So anyway, this did that, but this bar is still young, and we are near the half time period of this bar. And so far we have a reversal bar, very large doji bar. This is good for the bears to some extent because we are pulling back, and now bears have a chance to sell again based on the lower time frame, a weekly or daily chart. So this is good for the bears. A lot of the strong trend bars that you see, they pull back and then they close strongly. Now, that is also bad for the bears because why should the bears let this much of a pullback? Right? Now, if you remember watching the chart when the market is open and you see a breakout bar, for example, markets start to go up, you see a bull bar forming. There are two ways that bar can form. One way is that it moves up, hesitates, moves up, hesitates, moves up, which is ideal. You want to see that. Actually, three ways. So that's the best way. The second way is for the bar to start, crash up, and then hang in there a long time until it closes. That's actually not ideal because what you know from the behavior, what you can conclude from the behavior is that we had a vacuum test and then the market stopped going up. That is very common intraday too. You get a very strong move on the open and then trading range for the rest of the day. Okay, so that day is behaving that way for the higher time frame that it is building. The third way that a bull bar can form, a trend bar can form, is sort of like this, that the move starts, it moves up rapidly, then it pulls back deeply, and then it goes up and closes as a strong bar. Out of the three of them, the first one is the best. The second one is also not all that bad, but it is lower quality. The third one is the worst. And this is what bears might be getting here. And why is that?
Why is it the worst? Or
yeah, why is, if this bar comes down and closes here, and at the end of the month you don't see the tail, that is not ideal for the bear case.
Basically a trade.
Yeah, the lower time frame is reversing strongly. So that reduces the odds for the follow through after the bar. This next week, if you remember what I just said, please give yourself that practice, like intraday when you're looking at the formation of the bars, look at how they are forming. Are they trending progressively to the close? I can write it for you here so that you don't forget. So the three ways a trend bar can form. And this is intra-bar during its formation. So number one is progressive move to close with small pauses. All right, so the bar, this is the bar at the end. As it starts small, goes up a little bit, goes up a little bit, goes up a little bit, and closes. Actually, closes. 5 bars, 1, 2, 3, 4, 5. So 1 minute chart, 5 minute chart. That's the best case. So this is the best case. The second case is when you get a big move then not much gain. A big, let's say a big initial move, and then not much more trending till close. And that is when that bar is forming and you get, so out of that 5 bars, the first one is large. And then you get this, maybe that, and then close there. That is the second best. And the third one, actually the one that you don't want to see, starts in the same way. A big initial move. Then deep pullback. Followed by trend resumption to close strongly. And that's the worst of them. So you get, the 5 minutes that's building that bar. The first one is a big move. Then on the next minute, you see something like that. Tail. Sorry, that tail went the other way. And then it does that. So the tail is still there. Minute number 3. Usually it also pulls back again. And then minute number 5. Sorry. and then it becomes like it used to be. And then that part of that tail from the pullbacks are there too. That's actually the worst case, because the lower time frame is forming a trading range, and in many cases it might be doing this. So in the progress of, I draw it like this, but realistically it was up, down, up. So the two-legged pattern is actually complete. But in here it's not, it's just one spike. In here it's sort of spike, consolidation, trend resumption. So these two have better chances of trend resumption. This has the worst chance of trend resumption. And the monthly chart is doing this right now. Okay. So
Ali, sorry, I have a question here.
Yeah, please.
One of the common ways of the bar forming I see intraday is opposite of number 2, meaning that start with a trading range and the last 1 minute bar is a strong trend bar, and the 5 minute bar trends very strongly, close very strongly.
So
what is this?
Yeah, thanks for mentioning it. So it is the same thing. So consider this bar formed, and now the next bar opens, and this behavior continues, and then it closes up.
Yeah.
So it is, please look at, how the bars form. And if you get this, pay attention to the next bar, because sometimes this part continues and then you get that late breakout. So that is, so thanks for mentioning it. That's a very important point. So we can move this down, maybe make it number 4. That's the next bar, the follow through bar after usually this case. So let's do this. Make this number 4. So that will be the 4 base. A trading range, then a late big move, and that would be small, 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 big, and big. You can have a bear bar in the mix too, doesn't matter. It's just saying that we have a small range and then a big breakout towards the end.
That would be that considered climactic?
It is. As I said, it's usually something that happens after this sort of a formation. So you get a strong bar moves okay, or you get one of these, and then the next bar opens, goes sideways, and then has a late breakout. It's just the same behaviors that we see for legs and price structures on the bigger scale. They're happening in a micro scale as that 5 minute bar is forming. This is also quite common, that suddenly the bar grows and becomes, If you want to expand on this, you can add a few more too. Like, for example, the initial move can be down and then the market recovers from it. That's also a very common thing. But the point is, with respect to trend bars, this bar initially went up and then crashed down and then we're up again. My point is that if this is what you get in the halftime of the bar, that is not the best case for expecting this bar to get very, very good follow through. That is usually something that even if it closes strongly, it goes down and then reverses again, because this energy that came to the market to create that tail, that is there. I mean, we might not see it at the end of the month on the monthly chart, but it exists on other charts. And if you witness the formation of the bar, you have to remember that, because that's important. So far, what do we have here? We have a non-overlapping bar It's very large. Let's go back here. So it is equal to this bar, 25. Bear breakout and pullback on the same bar. Not much overlap with the prior bar. So that's what the monthly chart is doing. What is the outcome usually? If it stays like that and goes above the high of the bar or pauses or something, you usually get trend resumption. The bar itself is also a reason to sell the close because of the non-overlapping nature of it. But we are still, more than half a month away, so you have to wait. So far, it's doing what was expected. On the weekly chart, last week I said this bar is unlikely to get strong follow through. It's probably going to get a pullback. But I also said that because of the momentum and the type of the bar, it's a bear trend bar, very strong, very big bar. That momentum usually pushes the price past the low of the bar, and then if there's a pullback, it's going to happen from below the bar. And for that reason, if you're fading trend bars, it's usually better to place the limit order at a distance away from the trend extreme of the bar, because this is quite common too. Sometimes you get an inside bar, but usually, like look at this, for example, late leg here, this bar, big bull trend bar near the top, near the trend channel line, and several legs up. So this could be a candidate for fading, but you have to expect the bar to get triggered and fail. So this didn't trigger all that much. Market went above it a little bit and then reversed, but sometimes it goes above it by about 20-30%, sometimes 50% of the bar range, and then it pulls back. So this one I think went 20% if I'm not mistaken. I didn't measure it honestly. Yeah, so this is 50%. This is, so half of 50% is 25. This is probably 30 to maybe 40%. Drop below the bar and then reverse. This is actually quite a lot. But this was expected. You can also say that, yeah, weekly chart, 200 bar EMA, we've been above it for many bars. We created a parabolic gap and we're coming back to close it, all of those things. And then the 5,000 that I talked about last time, said market usually loiters around these major 1,000 increment round numbers. And here we just passed through it without too much hesitation. So when that is the case, it has to come back and test. That's usually what happens. Look at 6,000, right? Trading range for about a month and a half. But here we didn't do much, just crossed it. And then 20% pullback, which is an important price level for the funds and fund managers. What about next week? So this bar is bad for buying. Therefore, I think there are buyers within the range of the bar, but probably not at the close of the bar. Therefore, I think next week we'll come back down into the range of this bar, and I'm implying that we are in a trading range for the next little while, probably. So I'm not expecting another big bar like this to go down. That'd be low probability. But there would be a test to the close of the bar, the trap price here. And if bears are lucky to get that, then probably there are going to be buyers around the close and low of this bar. But I think that's very, very likely that we get pullback into the range of this bar. So the bear trend on the daily chart is not over yet. So let me erase that.
Mr. Ashari,
yeah.
Do you think so? Is it low probability for the stop hunt for the bulls, for the bears to stop hunt the bulls right now, based on the information we have on the weekly chart?
Sorry, say again.
So I'm saying, based on the information that we have right now, is it low probability for a stop hunt for the bears to hunt the stop of the bulls that have it below
I
that
think
bar,
so.
or do? Oh yeah, okay.
Yeah, because this area is support and this bar is large. Usually when that happens, the bar is not this big, but this is a very big bar. It's 700 points. What was the bear bar? Almost the same size. You see, they don't look the same size because this has a bigger body, but they're really the same size. So the bear bar is 699 points and the bull bar is 696 points, almost 97 points. So they're basically the same
That's so
size
cool.
bars. I didn't catch that. Can you repeat?
No, I said that's so cool that it's so symmetrical,
Yeah, so there are
proportional.
two opposing forces. Big down, big up, expect sideways. Yeah. I don't think that betting on the market to go below this bar is a very high probability bet at this point. Probably sideways, maybe close and low of the bear bar.
You know, I know we don't like to talk about fundamentals, but it makes when it kind of supports the price action rather than vice versa. I find it interesting because
Yeah, totally.
the announcement, you know, that caused that, you know, 700 point reverse is a 90-day pause, and
Yeah,
it would make perfect sense that for the next 90 days we're just going to get a lot of confusion within this range.
yeah, yeah. Isn't that interesting?
Yeah, it
We
is.
didn't know that's going to come last week that we were talking about this bar.
Right.
Yeah, but
Well, Trump probably has, you know, a technical trading advisor say, let's try to add more confusion. There's not enough confusion yet.
yeah. Yeah, if those guys want to trade, they can make a ton of money. I'm sure some of them do. So on the daily chart now, we have so 3, 4, 5. This is the beginning of the week, right? So it was the last bar of previous week. And I said we're going to drop below it and then reverse. Here's the drop and here's the reverse. The signal bar is not great. 4-bar bear macro channel, expect sellers above. So they got their trend resumption attempt. But then the bar itself is a bad low one short, which is, I've been emphasizing this all along, that if you get several legs in one direction and then there's a wedge or something, a channel that looks like a wedge, and then there's a low one short, that low one short is very low probability. If it is at an extreme price like this one, too far from the moving average right on support, it's even lower probability, so there are buyers below. And here's what happened. So they bought below the bar and helped by the announcement. So a 650 point bar day after, which is, I mean, this is very educational if you want to trade for a long time. It's a blessing, really, to be able to see this live happening in front of you and participate in it. It's very educational. And then big surprise. Let me do this. So we move this a bit further this way. So at this point, we have a sort of a double top, macro double top for the bears. But this top is higher. So there's an expectation that if you're a bear and you're really committed to shorting, that if you want to short here because of the overlap and everything's going on, you want to shorten the sell zone of that bar. And if the bar has a very prominent upper tail, that would be the midpoint of the tail and 2/3 of the tail up. So there's a sell zone here. Okay. If somebody sells there with a limit order and they get ran over by this bus, that price becomes support. In many cases, that is more important than the midpoint of the bull bar. If you look at the midpoint here, mid is 51.95, 51.95, almost there. And that is slightly below that midpoint of the tail of this bar. These bars are huge, but in lower volatility markets that you have to be a bit more precise with picking orders. Situations like this, that you cross a price that was reasonable for selling in this manner, that there was a tail and you wanted to sell in the sell zone of the tail, not necessarily sell zone of the bar, and it gets ran over, usually that price is a good limit order buy, either for a stop and reverse, or if you're flat, for just buying. So there is a buy zone here, and that 5200 is going to help you too, round number, that you should expect if the market pulls back from this big bull bar, which was very likely, because who's going to take a 700 point risk, or actually more, because the stop is down here, to go long just below the moving average? Those are all negative factors, low probability trade setup. So there are probably sellers above the high of the bar and at the close of this big bull bar, and there are buyers around the midpoint and where that tail failed, 5200. Therefore, we're probably going to be in a trading range for the rest of the week, which is what happened. Now, having that in mind, we can look at the intraday chart. All right, so this is our Monday. Let me find the PTM chart, because I marked the price level there that I think is important. 31st. Yeah, last day of March. Okay. Come on. Am I right? No, that's not right. It's not that Monday. It's this Monday. Sorry for that mistake. Wednesday. It's this Monday. Yeah, I thought it didn't look right. So 7. 7, 4. Yeah, okay. Bull breakout point of July 2023. This was a major swing point on the longer time frame. And it was likely that we were going to test it. But when we tested, it was very likely that there's going to be a bounce from it too. And it was tested. But, when you are testing those very long, historical support, it wouldn't probably touch it and go beyond it by 2 ticks. There would be some distance. And if this is the kind of volatility that we are having in approaching those prices, it's going to be quite a distance. But it doesn't take away from the fact that market is testing support. And we fell, that's 100 points, 150 points, almost 200 points below this, and then sharp reversal up. These were all low probability shorts of them, because of the context of this chart and also the distance from the moving average, how big this move is, 170% average daily range. So bad signal bar, bad follow through, bad follow through. But if you buy here, you should be able to scale in 50 points lower. So the buy is not an easy buy. So I say it needs scaling in, but I don't say how much. I'm saying it now. Look at the bars. So if bars are 50 points, you buy here, next buy is 50, 60, 100 points lower. So it's not an easy trade, but there's a buy there. And that line is important, July 2023. Just let's quickly look at that, because I want you to get a visual of it. So if we go to monthly, weekly, this is that line right there. Let's put a line there. Okay, major swing point. Sorry, this one, the higher one. Yeah, July 2023. This is important because we crossed it. Test was, very small, and then big rally. It's also the first pullback in this bull trend, so spike and bull channel. Market usually goes back and tests there, and if there is a major swing point, it adds to the magnetism of that price. So we fell there, 5,000, and then reversed up. So Monday, after this, it's probably a bull trading range or trend day. It's not going to be a bear trend day. And then very large bar, 200 and almost 50 points up there. It's not tradable. You shouldn't be doing anything here. Not buying, not selling, not nothing for a period of time until the market settles down. So theoretically, you can buy, your stop is down there, not here. If you put it down here, you run the danger of what happened because very large bars have magnets on both ends. And the support side of the bar, in this case, is also important test. You can do a research on it. A lot of these bars get actually tested to the absolute bottom. So if you're doing this, stop is down here and you are like now 500 points trade. That is 500 points times $5 is $2,500, $25,000, right? For a $50. Sorry, my mind is a bit.
Yeah, 2,500 if it's just one.
Yeah, $25,000.
But if you're,
for an E-mini. So not advisable to do anything. In fact, this type of market, a lot of traders shouldn't be doing anything. Maybe you can paper trade, but not real money. But you see what happened. So midpoint of the bar, buy zone of the bar is important, and the market pulled back deeply into it. So now that top of the buy zone is also resistance. Test there, and also now the sell zone of this bar is up there. So market goes there, and then there's second leg down. But it actually tests there. So that is important, which means now there are buyers below. So big up, big down, and then big up, big down. So expect trading range until this sorts itself out. But the dominant feature of the day is this. So breakout, tremendous breakout, very climactic. And this is the high price that was established. We did the homework on this, right? What is the probability of the market to go there versus not going there? For those of you who did that homework. No answers? Come on.
Rafal always answers it. I think it was 80%, 84%, or 73%.
Yeah, more than 75% chance that the market is going to approach that price and even go above it. So if it doesn't do it today, that is still in the books to be accomplished days after. But this creates a temporary trading range with that magnet still in place. So the day and the next few days are probably more bullish than bearish. And we test up there, so that was expected. But when we test up there, this is also the price that bears sold, and they got a 300-point trade out of it. So there are probably also sellers there. Don't forget that this is, let's quickly go back to the daily chart. This is now a very important price because this is the first pullback in a bear macro channel. So we're going to go up there and probably find sellers. Okay, that is the 8th, the Tuesday. All right, so sellers above there, very likely, very high probability trade based on the hard time frame. But if you take the trade, you're basically, if you're just selling with the limit order at the blue line here, this is that high. That is a situation where needs scaling in, because sometimes the breach of this price on the daily chart is going to be something in the magnitude of the daily bars. Not one complete bar, but 10% of it, 20% of it. That was the range of the prior day from here to here. That is 420 points. So if you sell there and you're basing the trade off of the daily chart, you should be able to scale in about 40, 50 points higher too. And that's not easy for a lot of traders. Easier to wait for the market to react to that price, get something underway, and then you hope that whatever gets underway does not have bars that look like bar 11 the day before. And this one does not. So it is very controlled, very organized. We talked about this today, so this is a perfect example of that. And you know from the size of the opening gap, it's more than 100% of average daily range. So this is limited on the upside. And this increases the probability of the day becoming a trading range day with a bull bias. And it's doing the thing that was expected. You get a tradable bull leg in the first hour or two, but this is also testing the higher time frame resistance. So you have to adjust for the context of the higher time frame, which is, yeah, we are going to do that, but then we're probably going to get sellers there. And when the sellers come in and start selling, then you have to trust that the higher time frame trade is working. If the higher time frame trade is working, you're not looking at, 30 points drop. You're looking at these ranges, 100 point drop, 150 point drop. So lots of opportunity left to sell, basically. And this is what we get. So spike and bear channel. The spike potentially started there up to there. And that's two measured moves down. So it's sort of. Or if you take the first part as this was a trading range forming up and down, and then we broke through it, it goes there. There are numerous ways of measuring this thing. One of them is looking at reversal patterns that failed. Here's one of them, a wedge or the entire channel down to here from there. Because this is part of the bull. One leg up, second leg up. So the bear bar here is actually pullback of the pullback rather than the beginning of that. And this is actually to the point of failure. So it should have reversed there, and it failed. It failed to reverse, went lower, and then there was this. So the way I like to look at it is, what did bulls have to bet that the market is going to go up? That was the last thing, because we had one leg down, buy signal triggered and failed, buy signal triggered and failed, buy signal triggered and failed, buy signal triggered and failed. This is the fourth one from here. If you count, this is the fifth one. This is a very high probability trade. If you buy this one, it should work. It didn't. So I would like to use this chunk as the thing that is going to be referenced for a measured move rather than the entire thing. But you adapt it, like you look at this and you have it in mind that there's a line there. And then you look at the smaller pieces, like this was a bull spike that failed. So we should go a measured move below. And then look at how we got there. This is very strong, so it's probably not going to stop there. A little bit more down, and then you have this in mind. So somewhere between this and that should be the end of it. Also, you measure the distance, how much the market moved this day. So from the open to about here is 233 points. Is already quite a lot. And then to here, it is 300 points and more, and then to here it is 364 points. And what's the average range on the daily chart? You should know it. So look at these bars. 400, 300. The big ones are 300. The small ones are 150, 200, 145. And then we have the issue of the pullback, which I explained. So you get a bar that's roughly about 300 points. That should be the end of it. So somewhere here, you should stop selling. For sure. I mean, it doesn't matter if the bars are still strong. That's not the trade you want to be in, because it's such a low probability trade to expect it will go to 500 points, for example. Small pullback bear trend. Usually the next day you get some sell-off, and then there's a high probability of at least about 2 hours or so of sideways to up. And that sideways to up could have started the day before with the strong reversal up. But first reversal, first break of the bear trend line here. First and second reversal down. So this is high probability. But it's not going to be a swing down, probably. It's just going to be one more leg down. And you look back at what failed. Selling above this failed, selling above that failed. So somewhere between these two bars or so, the market should find support. It finds vacuum move down there. This is hard to buy here, for sure, because 5 strong bear bars. I mean, it's 2 legs, or if you count this, it's 3 legs down. So difficult to buy, which means wait for something that becomes easy. Reversal and follow through, bad sell signal bar, buy that, or buy below it. Didn't go below it. Problem with Wednesday was that it was an FOMC minutes announcement. So generally you have to be a little bit more cautious, not as much as an FOMC day requires, hesitation and caution. But I've seen FOMC minutes days that do really wild things. So you have to be open to it. This was obviously news driven. This was when the news came out of White House, and it was before the minutes that are announced at 2 p.m. So 54 is the minutes announcement bar. And you see, it's like, it doesn't matter at all because this was so important. But the type that the day opened was very similar to an announcement day, that the market is waiting, it's going sideways, not doing much until the information is there, and then the market reacts to it. This type of a move usually has consequences beyond the day that it forms in it. Therefore, the next day is also going to be more bullish than bearish. Double wedges to high of the day, this is probably going to get a correction. But remember that the way that this thing began was with an outside bar. And outside bars are low probability for directional trading. So if you think about the counter trend trader, the market maker who will look at low probability setups for trends to do the opposite, if they sold it, they got trapped. So the close and high of this bar is probably going to be support. Also, the next bar, bar 47, initially sold off fairly significantly. So we went from, these bars look small, but they're not. We went from here to here. That is an 84-point move. And the lower tail of this bar, which at some point was a sell signal, so lower tail is 54 points. So it's equal to a bar like this. This bar is 40 points. It's actually bigger than this. Maybe, yeah, 50 points. Bar 63. So 63 looks like a good sell signal. That tail was like that when it began. So if somebody sold there, they're trapped. That area is probably going to be support next day. and you're testing down there. Okay, so we talked about this a fair bit. All of it is probably just a test of support, beginning of the bull channel. Sometimes the bull channel, the beginning part of it is this way. It's hard to see, but there's a reason for it to expect that the bull channel started from here, not from this pullback there. So test there, and then this is not going to be a bull trend day because of the amount of selling, but it's probably going to be a trading range day because there is support down there. And that's what we got. So very strong rejection of test down there. Test is successful for the bulls. These two are very similar. If you look at the 2 days, I talked about this one. I said it was hard to buy here. It's hard to buy here too. If one day does something and it's kind of surprising, you have to remember it, because usually you will see it happen in the similar number of bars, similar form or fashion the next day too. So this is an example of that. 2 directional tests to form higher low major trend reversals. All right, so that's for this day. Question? Was that question?
Yes, Mr. Chai. I just wanted to ask on the previous day, the day when the news was announced. So what I was thinking about that was it was until the news was announced, it was pretty much a trading range day. And then I thought that was a second leg trap, and obviously I got stopped out with some slippage. But were there any signs before that I should have taken heed of to not take that trade on bar 47, the reversal down for a second leg trap?
Yeah, so a couple of things. Look at what happened here. Do you remember what I said about the daily charts? I'm losing my voice. So this was the sell-off day, right?
Right. Yeah.
And I said that it's a bad low one short. So if it's a bad low one short, we should go above the top of it and run the stop. Okay, so now let's look at the intraday chart. That is that bad low one short. Where is the stop? High of that day. That's the line. So we should go up there.
Right. Okay.
It doesn't make sense, right? It's too far away.
The higher time frame context.
Yeah, it's too far away. It doesn't make sense when the market is here to traverse this distance so fast to get there. I mean, there was a news announcement, but from the higher time frame technical picture, we should go above that line. And it should happen on the next day or next couple of days. Nobody knows if it is going to happen next day or it's going to take 2 days or maybe 3 days to go up there. Because sometimes we get these low one shorts and the stop gets triggered, but it doesn't trigger on the next bar. It triggers across, several bars. Market slowly grinds up until it gets there. But it happens. Here's another example of that. So this is not as clean as I want it to be, but it serves our purpose. So if this wedge is correcting, look at the bigger picture. We have 3 big legs. There's this one, there's this entire sell-off, and then there's this last one. Now they have smaller pieces in them, they're complex legs, all that is fine. But if the market is reversing up and correcting this really, really big wedge here, it's going to go above the top of the last leg down, last sell climax. Last sell climax either started there or here, probably there. Okay, so if I put a line there, we should test there. Therefore, all of these sell signals here are not great sell signals. And if
Thank you
that,
so much, Mr. Afshari.
sure, no problem. If that is the case, and you get a sell signal here on the open, so we have a strong reversal and a short on bar 3, the stop of that bar is going to get hit. But you see how slowly it gets hit? It requires 4 bars for the market to get up there. Okay, so the same thing could have happened on the daily chart. We have this was how it was, so low 1 right there. We should go above that high. But it is not guaranteed that we're going to be above that high immediately the next day. It could take the rest of the week to get there. It just so happened that because of that news announcement, it just happened in one day. The other thing about your trade is there is no selling pressure in this, and there are magnets above the market. So if you sell there, you're taking, the short is also based on an inside bar, which is the lower probability sell signal bar. If you study reversals that come from inside bars, you will see that in most cases they fail and get tested within 3 to 5 bars. Here's an example. Okay, I think this is an inside bar. I'm not sure. Sorry, let's check for that. Low 32. No, it's not an inside bar. But usually when you have an inside bar reversal, it looks pretty much like this. It gets tested within 3 or 4 bars. So second entries are better for inside bar reversals. The wedge is okay. The problem is lack of selling pressure. Good wedges have opposite pressure in them. They have multiple legs, very clear, breaks of the trend line. Opposite trend bars, we don't have anything. There's just one small bear bar here, bar 35. And that lowers the probability for the bear case. In addition to everything that I said, that there are magnets above the market. So that was the problem with that short. Yeah.
So
Thank you so
actually,
much.
just one thing. I don't know if you just explained this and I missed it, but why do you think the top of the swing point that would get tested was bar 62 or the other higher swing point and not bar 72 high on Wednesday?
Say again, Castro.
So I'm saying if you just go a little bit left, you can see it. So I'm saying when you were explaining, I don't know if you just explained it and I missed it, but when you said the market is reversing and it's probably going to go above the last swing point, why not take 72 high, and why consider 61 or
so market is
51
fractal.
high?
Yeah, market is fractal, okay? And things get tested on a fractal scale. This is a complex pattern. It's a big wedge. One big leg, second big leg, third big leg. So if all of this is correcting, we should test there or there. But on the smaller scale, this is a wedge itself, and this is the last leg of the wedge. So when...
Okay, yeah, that makes sense.
Yeah. When the market starts correcting, it's going to go here first. It's going to go there next. And it's going to go there next. And it's going to go there next. And look at the number of bars. If this had 70 bars or so in it, 65 bars or so, it's going to be sideways to up for about 35 bars, 30 bars. But it's going to test there. So that's the highest probability magnet to reach to. The next one is going to take a bit longer. The next one is going to take a bit longer. And in the process, you will see what the market is building and then estimate the probability of actually reaching those prices. But yeah, you're right. I mean, if you consider that wedge, that's the easy target, low-hanging fruit, tested immediately. And you see that it is not tradable. You should
Ali, sorry, go ahead.
Sorry, Phil. Just 1 second. You should have bought a bear breakout to catch the test to up there, because if you want to buy it there, and that is the test target, you're risking 2 to win 1, because the bar is so large. This is 71 points. And what's the distance left? Even by the close. You see 32 points. So you have to risk whatever you're risking to gain half of it. So you're risking 2 to get 1, basically. That is a lower probability trade. That is what happens in trading ranges. You don't get signal bars, you get just reversals that get, magnetized to those, drawn to those magnets, and then market goes sideways, which is what happened. Phil, go ahead.
Thank you so much for explaining. That makes sense. Thank you.
No problem.
Yeah, would it be, I was seeing 70 as being the end of the wedge, possibly the end of the wedge, and with 71 being the breakout and 72 is it's not great follow through. Would that not be reasonable to think that the wedge reversal might happen right there?
When the last leg is very controlled and it is not that much climactic, the probability for that is significantly lower. You want the last leg to be either a leg in a trading range or a climax, but not a leg in a trend. This looks like a leg in a trend. Bars are getting progressively bigger. They have strong closes. They have open micro gaps. They are non-climactic bars. Everything looks very nice and controlled.
But it's also pulling away from the EMA, so I mean, I kind of thought that as possibly being climactic kind of higher time scale. I'm 15.
It could have been just lower probability. Compared to, wedges that end with legs in trading ranges, and the last leg itself is a tiny little wedge, like go, pause, go, pause, go, pause. Those are better. Or if it is 2 legs with the second leg being a climax. This is actually that. You see the second leg has 1, 2 big bars and then it stops. So it is volatility expansion, volatility contraction, but this is just continuously getting bigger. So that was the problem with this leg. It was very controlled, and small pullback bear trend, you should expect this to work for the bears. And the wedge argument is always lower probability. We had a lot of wedges that failed on this day. And that just shows you, wedges in the direction of the trend are significantly lower probability reversal setups. But please do a study on it. Look at this one, wedge, leg in a trading range. There's a strong part here. This part resembles this part. So expect one more leg down. But then when the second leg starts, it's already bad. This bar went too far above the high of the prior bar. Follow through, reversal, but then stops. Then outside bar, gaps are closing. And then the last leg starts with an inside bar, which is bad for trend resumption. And then correction up. So you want buying pressure, or you want a really very clear climax, and then test of support. So one of the things that makes wedges work is that you can easily see the support. That's also important. Or resistance if it is a sell.
Hi, Ali, can I ask a few questions on Thursday, please?
Yeah, sure.
So actually 3 questions there. So first question is bar 4 at the open. I thought it was a okay sort of a buy because I thought bar 1, 2, 3 consistently close within the bar and resemble some trading range behavior, and bears keep failing in terms of the breakout, and it's at the bottom of that strong bull lag to the left. At least there's some argument of double bottom, at least some distance up to the EMA. That was my assumption. But why in the end of day chart, you mark like bar 4 there. You didn't even mark a buy there. So I was wondering what's the reason why not taking the bar 4 buy?
My reason for that was we have a significantly big opening gap and it's getting follow through. So buying is bad until you have a second reversal on the open. And second reversal means you have to see it. The first one got triggered, good, but the buy was not high probability. The other thing is really this, okay? And the trading range is still quite a bit lower. So you can say the trading range is here, or this price, or this price, which I talked about. And this is above all of them. So it makes sense for the market to go a little bit lower to find support.
Because when I look at bar 4, it actually reminds me of the Monday. So let's say, what if bar 5 closed as a strong bull bar? So there's a bull bar, signal bar, bar 4, and then a strong follow through bar, bar 5. Then would that become a higher probability buy?
It would become a higher probability buy, but when you have a gap down with follow through, the day is overall bearish. So you have to be careful with buying below the moving average. Now let's say the next bar is a bull bar, it closes here, just below the moving average. I usually wouldn't take that buy unless there is a context reason for it. There's something happening on the left side of the chart that convinces me this is okay. And that happens. Like, for example, on this day, we had the same situation here. And this was not as low probability as it seems, although it's the same setup. You have a bear trend, you have a reversal, and you have a follow through, and the distance between the follow through bar and the moving average is small. Okay, so you're buying near the moving average where the moving average is resistance. But this is a complete price structure. There's a magnet, and that's this bar. So we should probably test there. That leg should reverse completely. So the moving average is less of a concern in those cases. Still, you see that there was a lot of back and forth. So people actually sold here. Market went lower, came back up. There was resistance on the moving average. So better to, if the market is in a trading range and you can see the trading range, it's better to wait to buy with limit orders near the bottom and sell near the top with limit orders than taking the stop order or market order entries.
Okay. Sorry, just as a follow through as your comments on that bar 40. If someone bought into that reversal into the EMA during the midday reversal, and then would it be reasonable to exit below bar 41? Because that's a potential low 2 and you can get a deep
exit
pullback
here.
into the exit below the low of the bear bar, I mean.
Yeah, if the bear bar gets triggered, yes, but remember that this is the very first bear bar. Well, what do we have? 1, 2, 3, 4, 5 bull bars. That is a low probability short. So it's okay to exit there, but it's also okay to buy there because you have 5 bars up. It should get at least a little bit more up. But because you have 5 bars up, it's going to pull back first. So the 5th bar, this bar is actually a sell bar, and this is not a good short. But because the market is in a in a bear trend at that point, this is very strong, and it will probably have one more leg down. Sometimes it starts from the moving average, sometimes it starts from a higher price. And for that reason, you don't want to be trapped in a bear market. Therefore, I agree with you that exiting there is a good caution. But for an aggressive trader, this bar is actually a buy setup. And I think that a lot of people wanted to buy below the bar. I was one of them. I didn't get a fill there. I wanted to buy here, right there. And I couldn't get a fill.
It's just as you said, like previously I tried with this method, but a lot of the time I got trapped into a low two from EMA, and then you have to scale in to get a break even, which I don't like to do because I think it creates more decision making that point.
Yes.
Yeah,
I agree with you.
The other two questions I have is quite similar to each other. Why bar 5 on Thursday still? Sorry. Bar 5 and bar 15 you mark as a low probability stop order entry. The reason, I mean, so I bought into bar 4, and then when I see bar 5 reverse, I thought, okay, then this is a gap down, and then we see a low 2, so a potential swing can start from there. And then when I see bar 15, again, I see that's kind of a sort of a low 2 from EMA, and we could end up with swing from there. But I'm not sure why those are marked as low probability stop order in the end of day chart.
This is a micro channel, and 15 is an outside bar. And it is not a strong outside bar. It's a doji type of an outside bar. Because we have outside bars that look like 30, and we have outside bars that look like 15. So this is a trend bar, outside bar. This is a trading range outside bar. Therefore, it needs one more bar to confirm the sell. But overall, if the market is in a bear environment, you can take signals that look a bit weaker or there's something wrong with them, because that momentum and market control compensates for the lack of clarity on the signal. And I think I mentioned, Bohan, last time that I'm just using a few type of markers to mark the trades on the end of the day chart. But we have a degree of probabilities, and degrees of probabilities are not 2. So I'm just using high probability and low probability. That's kind of binary. But in reality, there are like, 10 high probability ranges and maybe 10 low probability ranges. And there is some of the low probabilities are bordering the high probability start of the high probability. But I can't use, 15 types of arrows to mark the charts, already too crowded. So I have to classify based on overall, is it low probability, overall, is it high probability?
Okay. I just understand from a swing perspective, like if I want to look for opening swing, will bar 5 and bar 15 a reasonable swing entry? Because I'm seeing a low 2 after a gap down. Or I should wait for more confirmation.
Yeah, this bar is not great for selling, so probability is lower. But when it gets follow through, the probability becomes high. And usually, I mean, if you want to like cheat and figure out which bars are like a trick to figure out which bar is a high probability bar, look at the end of the day chart. At the end of the day, when you see everything, okay, you see all the bars there. Most of the high probability trades get a pullback immediately before they go. Those are points of clarity. This is a point of clarity, and it gets pullback. This is not. Okay? This is a point of clarity, gets pullback. You see what I mean? So usually, I mean, these are lower probability events, and that's why they were tested. So look at how far that test went. Point of clarity should get pullback. Market maker does the opposite. They buy here, and they got trapped. So most of those strong signals that are followed by pullbacks, those are usually good swing entries, as you see. Strong bar, good for swing. Now you know we're going to go higher, but pull back first before it goes higher. At this
47.
point, 27, yeah.
47. A good example of a low probability.
Yeah.
Yep.
Yeah, this is not great for buying, but then you get 48, which is now point of clarity. We have 3 bull bars. Theirs got trapped, pulls back immediately. That's a shortcut
Okay.
to figure out which one was high probability, which one was not. Less likely, 20% of them get immediate follow through and they don't pull back, like what happened on 22, 3, 4, all those bars.
Okay. Okay, it's actually opposite. I mean, I understand your point of clarity and then pull back, it become a higher probability event. But my initial understanding was also like if I enter with a low probability swing entry at the opening, I want a good follow through. So I thought bar 6 and bar 16 are very good follow through because they don't even bounce up much. It's just open and then it immediately goes down. So I thought that was confirming is a good swing entry. But okay, I see your point now. Thank you.
Yeah. The only problem with when you have a gap bordering 100% is that there's not much more in that direction is left, because that's the average bar range on the daily chart. And you know that I'm not using 20, 30 bars to calculate it. I'm using 8 bars, 7, 8 bars. So it's a short window to get updated quickly. And I mean, we have tremendous days these days, but again, a 94% gap down is too big of a gap to expect, a lot more down very quickly. It's usually more sideways or reverse, even go the opposite direction first. All of those things lowers the probability for selling when you have a big gap down. Big gaps usually result in trading ranges rather than trends. But when they result in trends, those are tremendous trends because they are low probability day structures and they shouldn't have happened. All right, so
thank you.
Sure, no problem. So Thursday was testing the big breakout here that we had. I talked about it. Second leg up was expected, but after this, the day wouldn't become a bull trend. It becomes a version of a trading range. So whatever we get is probably going to be limited, which is what happened. Despite many strong bull bars, it was still a bearish trading range day. One more thing is whenever you get this type of, let's go back to the daily chart. This type of very large moves, the highest probability is that you're going to consolidate first and absorb that energy. And if that is happening on the higher time frame, the intraday chart should form trading range day after trading range day after trading range day. And that's sort of what we had over the past, 2 days, Friday and Thursday. Both of them are trading range days. You can look at Friday and say, well, it's a bull trend. But that is not the case really, because we have a trading range here, we have a transition up there, and then this pullback closes the gap or touches the gap there. That doesn't happen in bull trends. And then the next one, and so how many bear bars are here? And then the next one also closes the gap. So overall, market is exhibiting trading range price action behavior. And therefore, the day is probably consolidation day, although it gets moved up because that significant breakout, this has effects that's going to last beyond the day itself. So you're going to see the aftershocks, so to speak, on the subsequent days, but because it is countering a bear trend, it's also going to be mostly sideways. All right, any questions?
Hey, Mr. Afshari.
Yeah.
I just have a question about your trade on Thursday. The one you said you were buying the 40.
This bar.
Like before 41, yeah. Was that for the stop hunt on top of 41 for the profit target?
I just thought that the market is going to go above this bar 29 because this was a reasonable buy and it got triggered and failed. And there was no opportunity to exit break even on that trade. And if the day is going to be a trading range day, market comes back to that bar. And as I explained, this is a first reversal down after 5 bars up, so low probability short. was expecting that it will get triggered and then it will go to the price that I thought it will go. It didn't get triggered, got an inside bar, and then broke, immediately went there. So
Okay, thank you.
failed signals, you're welcome. Failed signals in trading ranges are magnets. And if they, especially if they get triggered like this one, then people buy and scale in lower and they expect the market to go back and let them get out break even. So if you are not trapped and look at those bars and remember them, and then look for setups that help you to get into a trade in that direction, to demagnetize them. All right, so I guess that's it for this session.
Hey, Ali, it's just a very, very quick point on this trade again. So if you want to buy below that bear bar and it didn't fail you and you see a bull bar, would it be reasonable just to buy the close and chase the market up?
Yeah, but what I usually do in cases like that, I look at the 100 seconds chart and find something there that I feel comfortable taking, and I use the lower time frame to find the entry point.
Okay.
In this day, I didn't do anything. I didn't buy again. But I was not expecting a fast move there. I was expecting the market's going to transition above the moving average and go sideways and then test. But sometimes you miss things, and that's okay.
Okay, because that's what I did. I bought, I forgot where I bought, but probably around, that strong bull bar open when it pulls back. And then when I see that bear bar at the EMA, I put the exit below that bear bar. Then I see the bear bar didn't trigger, and then we end up with a bull bar. I just add more to the profit target of,
that makes sense too.
Yeah. Okay. Cool. Yeah. Thank you so much.
Sure, you're welcome. All right, so I guess that's it for this session. Good to
Another
see
great
you, everyone.
session.
Thank you very much.
Take care.
Thank you so much.
Thanks, everyone.
Ali.
Bye-bye.
See you
Take
next
care,
time.
everyone. Bye-bye.
Take care.
Bye.
Bye.